Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, October 2nd, 2019. I wanted to get these charts out, this video, and again my thoughts, because it's a whole lot easier to put my thoughts into words in these videos. There's just so many different things to watch on the charts, so I'll kind of touch on some of the things I'm looking at now. Start out by saying, first of all, these look like the real deal, and I expect these breakdowns will stick. What I'm referring to, there's a benefit of the doubt trend line. That's an impulsive move. That's an impulsive breakdown. Took out that support line there. I have a lot of different boards, different charts I'll share, but we're back well into this. You can see the box here. And QQQ has been in the trading range, but QQQ is now even back below that August, the midpoint of that August trading range. SPY has broken down as well. Remember yesterday, SPY dipped its toes down into the top of the August trading range, but now well down in there. So by nearly all metrics, most accounts, the breakdown's pretty legit, pretty solid, and I want to show you some other levels and some things to consider now. I went ahead and just pulled the trigger on this on the SOXX short trade, the semiconductors, and a lot of you've been asking, waiting, and I've said this for many weeks now. Look, I believe both on the broad markets and the semis that it was made sense to have a starter short position. And I'm not. There are points in time in the market, for example, back in 2018, where I saw very clear hard entries. If you recall back then, you go back on the post right around the beginning of October, we were watching day after day after day XLK, waiting and saying that's when when the tech breaks down, the market will break down, and that'll trigger sell signals. There it was right there. That was a clean hard entry, right? And it played out well. This has been more of a sloppy, whether there's manipulation going on or the technicals just aren't as clear now. Doesn't matter, same difference. And we had a couple breakdowns that looked like we broke down, punch back up. I had to use the alternative BOD trend line. Again, today's breakdown it's pretty clear. There's a gap down and we're well below there. But what I'm getting at here is the whether it's the powers that be that are trying to keep this market up or not, there has been a lot of stick saves, false breakdowns, rallies back up. And so I'm going to give you levels to watch, and as I said in that SOXX trade, I still think the best strategy is a soft entry, meaning a scale in. The risk reward for weeks, even months now, has been very lousy, and so I've maintained that nothing's changed there. Even if we rally back up and stick save today, I still think the upside is limited. But you want the highest probability sell signals. You'll want to see weekly closes below all these trend lines. So I'm going to start there, and at that point, and I'm talking, by the way, guys, I'm talking swing trades. I'm not talking the active trading stuff that I've been highlighting a lot recently. Go long NQ here, sell it a few hours later here, reverse it short. That's all active trading stuff. Once the market breaks down and out of these levels, we should have a nice tradable trend, and that's what I believe will happen, and that's why I'm doing the video. That's why I added the SOXX trade. QQQ, I'll have to look at that. I could have sworn that I did an update stating that we just had our stop clipped one day. I wasn't going to keep raising stops, but throughout that whole trade, really the last trade is still an active trade for a lot of you, because I told you guys I was extending my own stops, and I know a lot of you have as well. So 6 to 1, half dozen to the other. When you go to QQQ, you just look at those old trades. Nothing's changed, and I've said that before too. The price targets on that trade remain. Where are they here? Okay, one board here. There it is. These targets. And so, it's all about risk reward, and that's just right now. We have a potential for target, and I'll probably make that an official target soon, and almost certainly if we get the weekly breakdown. So here, let me jump back to what I wanted to cover on the weekly charts. All right, so we have these trend lines off the lows on December 24th, and now we have a pretty solid weekly candle below it. Today is Wednesday, so there's 2 days for this market to snap back up, whether it's one of Trump's infamous well-timed tweets, oh, things going great on the trade wars, or whatever it is. you guys know my thoughts. I've talked about this for weeks. I'm surprised it's taken the masses this long, if you know, if they start to do it, to realize it's a boy who cried wolf scenario, that it's all been complete BS. You know, the trade wars, we're not any closer now to resolution than we were then, and you know, with an, you know, an impeachment hearing going on, or investigations of Trump right now, China's got the upper hand. They're just going to sit back and see how this thing goes. I don't think there's really much coming in the way of anything with substance. You know, they can come out and eke out a deal that the White House can try to spin as a win. But anyways, that's, you guys will have your own thoughts and opinion on that. But where I'm going with this is, let's watch the next time we have a Fed mouthpiece come in and talk up the market, or the president directly, or somebody from the White House, and see if it has a lasting impact. If it does, and we get back above these levels on a weekly closing basis, then you're going to have a big old bear trap whipsaw signal. I don't think it's going to happen, and the charts tell me there's more downside to come, but again, it's early in the session as I'm doing this video number one. We could still stick save by the end of the day. When I say stick save, talking a candlestick that's broken down below a support level and then rallies back up to close that candle at or back above support. So again, the odds are pretty low right now because we're well down below there, but this, all that matters on this weekly time frame, the only thing that matters is how that candle closes. And it won't close until 4 p.m. on Friday. That's when the end of the week is, the weekly candles. Now, if we were to keep moving down today, tomorrow, and this weekly candle by tomorrow looks like this, the chance of a stick save diminishes. Once you get so far away, it's going to be nearly impossible to recover all of that within 1 or 2 trading sessions. Let's just say this is where it looks tomorrow afternoon, or even today, or Friday. You're probably not going to get that stick save. All right, so let me give you other levels to watch. Same stuff I've covered in recent videos, but if you're new to the site, 200-day exponential moving average, a big level. It's this red line here. Yes, you see it as a 40-week or a 40-period exponential because I'm on a weekly time frame. There are 5 days in a week. 5 times 40 equals 200. So it's the same line on a daily chart as the 200-day EMA. Does a great job of defining bull and bear trends. And so after a breakdown like this, where you have a trend line, a breakdown, you want to see a break of that. We gave it up there, and that was a 20-something% drop in QQQ. We recovered it. We broke it there again. You had another big drop there. Right here in the fourth quarter, we broke it, made a almost perfect back test, and then moved down. So that would be, let's just call it the nail in the coffin. And again, you need to see it on a weekly close. So nothing's going to happen definitively between now and at least 4 p.m. this Friday. But those are things I'm looking for. And that, I can say with a pretty high degree of confidence, would be your all-in short moment. Now, when I say all-in short, please hear this. You know, a portfolio, I talk about this all the time. I'm a big proponent of asset allocation. There's your portfolio, whether it's a active trading account or an investment account. You need to determine what your allocations are going to be to stocks. These are equities, whether you're long or short, and then different sectors within there. Bonds. You know, I'm a big believer in, you know, having bonds, whether it's long or short at the time, but Treasury bonds, they should go up when stocks fall. So if all this plays out, then, you know, my allocation will be short stocks, long bonds, and then precious metals. I'll try to, this really isn't a pen tool here, but a little line tool. Precious metal, these are not to scale, but that would be gold, to a lesser extent silver and the other ones. They've been tracking well, but gold's the true flight to safety asset. And of course you can trade the miners in there. So when I say PMs, it's the miners as well, and everything else. And then commodities. I'm probably not going to be able to draw a C very well. So these are pieces of pie. And then cash as well. That's C for commodities. Any that look good there. And so when I say an all-in, whatever allocation, whether to you, aggressive trader, maybe you're 100% short the markets. And if that's your thing, fine. Otherwise, maybe this number will be 30%, 20%. And the nice thing, if you are more of an investor, not an active trader, you can use these leveraged short ETFs like SQQQ. It's 3-time leveraged short on the Qs. Normally, I say stay away from these as anything other than quick active trading vehicles. But here's the thing, and again, a lot of stuff I want to get out to you guys. One reason I love shorting stocks is stocks tend to fall a lot faster than they rise. If you don't know what I'm talking about, take a long-term chart. Go back as many years, as many decades as you want. Look at the bear markets, look at the corrections. Usually you see months of gains wiped out in just weeks. And that's quite common right here. In just a few days, you wiped out, over a year and a half of gains. That is typically what happens. So therefore, I'm more comfortable holding things like SOXX, a 3-time semi-short, or SQQQ. And if you want to take the leverage factor down a little bit, I don't go off on too many tangents here. There's 2-time leverage ETFs like QID is a 2-time short, or non-leverage if you don't want to use any leverage. But where the leverage allows you a little flexibility is if you're in your portfolio. If you have whatever your number is. Let's say you have a $100,000 account and you want to go have some short exposure, but it's not everything. You want to still hold your stocks. You still have your Apple and your Facebook and things that you've had forever that you're never going to let go. They're in there. Instead of, let's just say, we'll keep it simple. Say half your portfolio was all your Apple, Facebook, Amazon, all those things you love and you don't want to let go, at least not at this point in time, because you believe we're in a bull market that may have a lot more room to go. But you want to hedge them up 50%. So you could buy either 50% of your portfolio, the other half, and put it in this PSQ non-leverage, or you could buy 1/4 into QID, which is remember that has 50% leverage, so you only have to buy half as much. Or you can buy 1/3 of SQQQ. And what that's doing is it's allowing you to free up cash. So in that case, in the same $100,000 portfolio where you have half your money into equities, whatever they are, you put a sliver, about 1/3 of your portfolio into SQQQ, and now you have effectively, it's not a direct hedge, but it's close to it because they're at the top heavy components. You have a direct hedge on your equity positions, and you have a lot of dry powder. Over 2/3 of your portfolio right there. Oh no, I did that wrong. You have 1/3 there, half there, hedging that up. Sorry, to do that more correctly, that would be if you had 1/3 of your positions in SQQQ. I'm getting off track here. You have to do the math. But what it does is it gives you some cash, frees up cash for other opportunities, whether it be commodities or individual stocks, or you just want to have that comfort level with something that won't go up or down, because you want to, maybe your goal is during the next correction or the next bear market, maybe it's not to profit from it, but rather to just stand aside and not lose anything. So all right, those are some trading tips there. Let's go back to the charts and look at everything, and then we'll wrap this up. I want to get this video out to you guys, and just like the pass along trading. All right, so look, the divergences have now, for the most part, been burned out, and NQ, hanging on by the skin of its teeth on this one. This is RSI 9. Sometimes I'll use an RSI 14 setting, and on this 60-minute chart, it's RS 9. So there's still potential divergence on the NQ futures 60-minute chart. And let's zoom that out a little bit, and you can see what we're looking at here. So here's those bear flags, or bearish pennants, I should say. It's a very close cousin to the flag, and they've played out and then some to their measured target right now. That's the pennant right there. There's the flagpole. There's the impulsive move down, and we had halfway along the way we had a little flag action, a little in a smaller scale, little bear flagging action, and now that's played out. So that's that. The divergence is now burned out, at least in the PPO. And let me zoom out a little longer on this chart and just see if there's anything. Again, at this point in time, guys, I really turn my focus more to the daily charts and even weekly charts, because right now there's just not much to look at here on the 60-minute chart. We've dropped. We are about in the midpoint of the Q. No, we're a little bit below the midpoint of the QQQ trading range from the August trading range. It's right there. That's my midpoint line. We're below that now. Not a good sign. Nothing but bearishness right here. I don't see really anything here to say, wow, you know what? we're going to probably rally from this point. ES, let's look at that. ES, well, here's the midpoint. There's a midpoint line about 28.93. I didn't measure the midpoint out exactly. If you're not sure what I'm talking about, when I see a price channel or a sideways consolidation range, usually you can put a line somewhere around the midpoint. You can see here it's a little bit north of the midpoint, but it is a level that is very well defined where we trade. This was a brief overshoot on the initial leg down. Then trading normalized here with the equal lows, 3 equal lows about that point. And so you can see you either traded below that midpoint line and it acted as resistance every time you hit it, and then once you broke it, you didn't just kind of limp on through. You had an impulsive rip right to the top, and then you can trade off that point. You entered it here briefly. It's nothing perfect, and then you snap back above it, and you also regained it impulsively. Then you broke it, and you had an impulsive leg down to the bottom. So you can see, to me, that's a very clear visual line. So there is a support level on ES, but 60-minute chart stuff. So the takeaway from this is where I start to turn my focus now to the more significant daily time frames, because when we're in low volatility, when we're holding above support, yes, I'll actively trade off those 60-minute charts, even 15-minute charts. But now we've broken down on the more important weekly. That means, plain and simply, the floodgates, the dam has broken. The floodgates have opened. And this should trigger more and more selling. And again, we have that 200-day coming in. They usually buy at least the initial tag of the 200-day, and this is a point where you have to make a decision. Do I want to try to game the bounces, or look, we have some pretty good sell signals right now, and do I want to just sit tight on my short positions? It depends on what type of trader you are. If you are not an active nimble trader, I would say you're pretty good here. If you get those confirmed additional sell signals, breakdowns on the weekly charts, or even if it looks like we're heading into it on Friday. That's the other thing. You don't have to wait till 4 p.m. As I said earlier. If on Friday at, let's say, 1:30 in the afternoon, a couple hours ago, we're trading down here on QQQ, and there's very little chance for a snapback above that 40-week moving average, and especially above the downtrend line, then you could add to it at that point. Okay, I'll run through some others. XLK, there's your breakdown. Solid red candle, again, impulsive. So far, the day is young. We'll see what happens. But as of now, that is a sell signal. But again, I have to throw the caution out there that anything is possible before the close today, and then that could mean that we had some whipsaw signals here. Wouldn't be the first time in this bull market that we had what looked like a solid breakdown and proved to be a whipsaw signal. Daily chart there of XLK. Pretty clear breakdown. The XLK trend line is fairly well defined. It's not as well defined as it was back here. This was a clean breakdown back test, and never looked back from there back in the last fall. But so far a breakdown. And remember too, we have seasonality coming in here, guys. This is not coincidence. You go back in time all the way to Black Monday in October 1987, the biggest single day drop in the markets in history. Yes, that was October, and there's been a lot of big market moves to the downside in October. So we've got that working for us as well on the short side. SPY traders, I've shared this in the past, recently in recent weeks. Here are some potential targets if you're swing trading SPY. I like QQQ because you get more bang for your buck. Let's see what they're at right now. SPY is down 1.65. QQQ is down 1.77, a little bit more, but that's typical. Usually, on a down day, you're typically going to drop more than SPY if you're in QQQ, and on an up day, you'll go up more. Minor trend line support right here, so we need to watch this too. And again, each of these are support levels, and the way this stuff works is if and as each level is broken, because we have some pretty powerful sell signals, this is where I don't plan to game the bounces anymore at this point, the pullbacks to support, because what tends to happen is this is where longs should be stepping in, but once you break down, they usually get overrun with the sellers. And now, as I always say, support is support until unless broken. So you have intersecting support levels there, about 288, the midpoint of the price trend on SPY that I just showed you, and an uptrend line. So if let's say you are kind of doing a soft approach, scaling in a little bit skeptical, been burned a few times shorting with the market reversing, then what you want to do is wait for a break of that level, an impulsive move down below there, especially a daily close below that levels, and that should open the door up to this first target, which is the bottom of that zone. And as I told you guys before, I think what happens is, I think if we start going down here, the selling should accelerate. We may just blast right on through that first target zone, because if we get anywhere near the bottom of the August trading ranges, it's already pretty bearish now that we're halfway in there on SPY. The closer we get to it, that just shows you this was a, that these divergences are playing out. All the bearish technicals are playing out, and then we could have a pretty swift move down here to this third target. And that's still another, to measure it out for you, that's another, in the S&P alone, about a 9% drop. QQQ, there's multiple targets here on QQQ. But if we get down here to that comparable level, which is, I think this is a comparable level to the one I just showed you on SPY, that's about a 15% drop. Why? Because that's the April, see the lows back here from this correction in January of 18. And that's where, no, I had that line a little higher there. So I'll need to, I maintain that level. I think that's more important support on SPY. It's not aligning perfectly with QQQ, but this is pretty good support on QQQ. So we'll see. I often modify price targets as I go. So let's just, first things first. Let's see if they take out the 200-day. Let's see how we close today, number one. Start there, and then of course how the rest of the week develops. Okay, and for the risk-off assets, gold took out. It stalled yesterday and reversed off that target, almost perfect, 1492. It set up this a bear flag pattern right here. You see that flag. I'm gonna clean that line up a little. I'm trying to move that line down to show you the flag, and then broke out. And this stuff. This is why I tell you that the gold, although a completely different asset class, unrelated to equities, but such a strong correlation, especially during times of market turbulence. It's right now, and has been for a while, risk on, risk off asset. It's risk on. I'm sorry, risk off. When risk off, meaning people are selling stocks, that's what does well. And by no coincidence do you have a bearish bull flag pattern right there, which has played out almost perfectly so far to measure target at the same time when you had the bearish pennants in the indexes. So there's gold, regained that. This is big, guys. Gold regained 1492. It was this morning, it was right on there when I did that update, but since then it popped above it, and it's solidly above it now, and I talked about that before. If we punch down through here, this was a big, you look at it this way, this is a big fat bear trap in gold. All those that added swing short positions, saw gold was going a lot lower on the break of 1492. There was definitely a short-term trade to be made, and then a bounce off there recently. But I just wanted to say, longer term, this is bullish right now because we're back above that key 1492 level, and if the market continues to melt down or head down, it's not a meltdown mode yet. We could work our way up and then ultimately break above this multi-month trading range. So so far that confirms, because what I'm trying to say is the fact that gold has broken out now, regained 1492 with conviction, helps to confirm the bearish nature of this breakdown, and tells me that it's probably going to stick. This is institutions, individuals flocking into gold right now, and it took back a key technical level. Silver 16, remember that was the target yesterday on the breakout here, had us going up to 17,404, pull back, and which we did, and then 17,655. This morning we were right here, and the market started to break down. We took it out, so that's the second target has now been hit in silver, and that's the silver futures. And I did have a request on the front page. I'm trying to not make these videos so long. Sorry guys. Do want to cover this one real quick. Somebody asked me to do an update on Treasury bonds, and TLT, you get a better feel in the charts, but here's you get a better chart with looking at the futures, I should say, on ZB. But here's what I see on TLT. Remember, they're a risk-off asset, and so they're likely to rally and continue to rally. We had a divergent high. They got ahead of themselves. We had a nice correction. We corrected all the way back here. This was a potential target. way back when there was a big old gap. It was backfilled almost perfectly, 136.54. That has now worked off the, or I should say, worked off the overbought conditions. We became almost oversold, and we've rallied back up, and now we're popping above this. This was a resistance level, and we're starting to clear that right now, 143.30. And by the way, I don't have any upside targets right now. Favoring gold, I don't know how much more upside we have, especially on the long bond. And not crazy about it. It is a risk-off asset. You might do better sticking with some shorter-term bonds right now if you're looking for safety, IEF or even SHY. IEF is the 7 to 10 year Treasury bonds. SHY is the 1 to 3 year Treasury bonds ETF. You're not going to have as big of moves in the shorter-term bonds. They're not as rate sensitive as the long-term bonds. But let me show you ZB real quick. Somewhere down here, there it is, ZB. Remember that was the target there in resistance, 163.070. We popped above it a little bit. Not very impulsive. There is a little bit of divergence going on here too. So like I said, bonds will most likely rally. And the next target, I could just show you right now, is about 164, 120 right there. Pretty good resistance level. In fact, that's where I think if there is more downside today and or this week, this is most likely where treasuries will go. And then at that point, probably a good idea to maybe step aside, take some profits, or at least trail up stops. But again, probably more upside in gold, I think, at this point in time, dollar for dollar. All right, I'll cut it off here. 26 minutes. I'll try to keep these, short as possible. But again, these are all interrelated things, so it's pretty simple. Stock market continues lower, which at this point, that looks to be the most likely scenario. That should help these risk-off assets such as gold and treasury bonds. But also speaking dollar for dollar, you probably get more bang for your buck in shorting equities. And then of course the semis. I told you I'd stop it here. I already put an update on the semiconductors. Those have yet to break out. I showed you actually the SOXX chart. SOXS, but let me show you SOXX. That one is still above trend, but my logic here, my thinking is, since the market broke down, unless it proves to be a whipsaw signal, this will likely break down as well. If it doesn't, again, that's why I gave you that post, and I said in there, you can hold off and wait and add, if you've been scaling in, or whether you have or haven't, wait in for a solid break and or daily close here, especially a weekly close. But there looks to be a lot of downside in the coming months on the semis. I mean, more bang for your buck by far than the stock market. Even if these are my swing targets on the longer term chart. There's about an 8.25% drop from where we're at. 19%, and ultimately down here about a 30% drop. So, all right, I'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.